Hello, I'm Vince Lancy, and this is the Hartnett Flow Show walkthrough. If you are a subscriber to Zero Hedge Premium, I would suggest you read their report today. It came out yesterday. We'll be doing a very dry run because of the volume of material in this report. So let's get started. Hartnett's weekly report is presented two ways: a video walkthrough with commentary, and the second way is Hartnett's main points are broken out below. New subscribers are encouraged to listen for translations of Michael's particular brand of lingo and the Goldfix nuanced take of his Exxon analysis. There'll be very little nuanced take. There will be much dry reading in English. Let's get started. Scores on the doors: gold 35.1%, Bitcoin 18.4%, stocks 15.0%, high yield bonds 8.6%, investment grade bonds 8.6%, government bonds 6.3%, commodities 3.8%, cash 2.9%, US dollar minus 9.3%, oil minus 11.7% year to date. Invisible hand to invisible fist is part of his main section. He deals with, topically, the parallels between what we are about to enter into and the 1970s, particularly the late 70s stagflation era. So the key terms would be Nixon, stagflation, gold, crypto, a weaker dollar, and yield curve control. They're all discussed here. Zeitgeist. Only thing stopping the Nikkei going to 60K is our domestic politics, a Tokyo investor. Surprise will be Xi Trump deal trading China FX appreciation for lower US tariffs, sending Hang Seng well above 30K, a Singapore investor, which would be a black swan worth keeping in mind. This ends in one way or another with a conversation between China and the US. And what is it that the US needs from China that makes us blink? It's rare earths. What is it that China would want in the least to back off their stance, their own protective stance? And that might be China FX, China's currency, to appreciate against the dollar. When you think about it, that's what they're doing. China remains pegged to the US dollar in a soft fashion, but is debasing against gold, forcing the US dollar to debase against gold. So you have a triangle here. This ends with gold higher either way, I think, is the answer, unless China completely folds. Let's move to the meat. The price is right. UK long bond yields are at 5.6%, their highest since 1998. France is at 4.4%, their highest since 2009. Japan is at 3.2%, highest since 1999. And the US is testing 5%. Risk assets are cooling as markets price in what he's calling PKO, price keeping operations, such as yield curve control, quantitative easing, or Operation Twist to contain debt costs. Bank of America's stance is to be long gold into yield curve control with the view that lower yields from PKO plus credible Fed rate cuts would broaden equity gains into bond sensitive sectors like biotech, REITs, and small caps. A founder had asked about part of this, so I'm going to give a little bit of an elaboration. What he's saying is, first of all, PKO means anything that the government is doing to keep long-term yields down, right? Price keeping operations. Until they officially announce something like yield